Gold has captured global markets' attention this year. The precious metal embarked on a significant upward trajectory. By May, gold's year-to-date increase was 20%. April saw gold close at $3,302 per ounce. It even touched an intraday high of $3,434. Analysts are dissecting the factors at play. Economic indicators, policy decisions, and global events shape the market. The coming months will be pivotal for gold's future. Several key factors have contributed to gold's recent surge. A significant event was the U.S. credit downgrade by Moody's. On May 16, 2025, the rating agency shifted the U.S. credit outlook. This action immediately spurred risk aversion among investors. Consequently, demand for traditional safe haven assets like gold increased. Global interest rate policies have also played a crucial role. Central banks in major economies have been active, with the People's Bank of China and the Reserve Bank of Australia implementing interest rate cuts. Gold, which does not offer a regular coupon or dividend, benefits in such scenarios. Furthermore, bond markets began pricing in more U.S. rate cuts. Inflationary pressures and broader economic uncertainty have been persistent themes. Rising U.S. inflation projections caused concern among market participants. General market volatility also encouraged a flight to safety. Trade policy uncertainty, particularly concerning the United States, added another layer. Finally, strong inflows into gold-backed exchange-traded funds provided significant support. The first quarter of 2025 saw substantial investment in these products. This robust institutional and retail demand through ETFs demonstrated strong investor conviction. As gold trades at elevated levels, attention turns to support. Key support levels are crucial for traders. They represent price points where buying interest may emerge. The $3,000 to $3,050 range is a critical support zone. Holding above this area signals bullishness. A breach could shift market sentiment. Section 4. Potential pitfalls, profit-taking, economic data, and Fed influence. Despite the current bullish sentiment, several risks could challenge gold. One prominent risk is profit-taking by investors. After a strong multi-month rally, some participants may look to secure gains. This is a natural market dynamic. Such selling pressure could exert a downward force on prices. This was already observed as a drag on performance. The higher gold climbs, the greater the temptation for profit-taking becomes. Upcoming U.S. economic data releases are another key factor. Figures on flash PMIs, housing data, and initial jobless claims are due. These reports provide insights into the health of the U.S. economy. Speeches from Federal Reserve officials will also be scrutinized. Any indication of a more hawkish stance from the Fed could negatively impact gold. Stronger than expected economic data might also have a similar effect. As of May 2025, Fed officials remain cautious. They have indicated no immediate plans to reduce interest rates. Rising yields on U.S. Treasury bonds present another challenge. An increase in Treasury yields can make these government bonds more attractive compared to non-yielding gold. Section 5. Continental worries and tangible demand, ECB and physical gold factors. Concerns from across the Atlantic could also influence gold markets. The European Central Bank, or ECB, has highlighted potential risks. It noted that increased investor exposure to gold and gold derivatives might pose a threat. This threat is to European financial market stability. The ECB's reasoning centers on potential liquidity stress. It also points to the risk of margin calls for investors. Such warnings can sometimes temper investor enthusiasm. The scale of gold derivative exposure is considerable. Gross notional exposures in the euro area reached €1 trillion in March 2025. This marked a 58% increase since November 2024. A significant portion of this trading occurs over-the-counter, or OTC. This means it is not centrally cleared. On the physical demand side, persistently high gold prices may have an impact. Jewelry buyers represent a significant component of overall physical gold consumption. If prices remain at very elevated levels, demand from this sector could dampen. Consumers might postpone purchases or opt for alternatives. A slowdown in jewelry demand could remove a pillar of support. Section 6. Global thermometers, geopolitics, dollar dynamics, and central bank activity. Geopolitical tensions have historically been a supportive factor for gold. The metal is often sought as a safe haven asset during times of conflict or instability. Current global events such as the Russia-Ukraine war have contributed to this demand. Tensions in the Middle East have also played a role. However, any significant de-escalation of these conflicts could change the picture. A notable easing of geopolitical tensions might reduce gold's appeal. The strength of the US dollar is another critical determinant for gold prices. Gold is predominantly priced in US dollars. Therefore, its relationship with the currency is typically inverse. A weaker US dollar generally makes gold cheaper for buyers using other currencies. This can boost demand and support prices. Recently, the DXY, or US dollar index, fell 0.21% to 100.17 on May 21, 2025. This weakness supported gold. Central bank purchasing activity has been a key pillar of support for gold. Many central banks have been actively increasing their gold reserves. Section 7. Navigating the future essential signposts for gold investors. Looking ahead, investors in gold should keep several critical factors in view. The trajectory of U.S. Federal Reserve policy remains paramount. Decisions on interest rates and quantitative easing will significantly influence gold. Any signals of premature tightening or prolonged easing will be key. Market sentiment can shift rapidly based on Fed communications. Therefore, monitoring Fed statements and official speeches is crucial. Economic indicators from major economies also warrant close attention. Inflation data, employment figures, and GDP growth rates are important. These provide insights into the overall health of the global economy. Stronger economic growth might reduce safe haven demand for gold. Conversely, signs of economic weakness or persistent